Anna, we're going to talk about assets today. Now, explain to me, if you will, do assets have something to do with every type of loan?
No. And in the mortgage industry, we pretty much divide up transactions into two main types. One of them is a purchase transaction, when someone's buying a new home, and the other one is a refinance transaction. And assets apply to each only to different levels.
All right, so can you explain to me a refinance loan? Let's start there.
Well, again, there's two types of refinances.
Nothing's easy, is it?
Nothing's easy, right? Well, a rate and term refinance is when the borrower is going to be rewriting their loan, probably to a lower rate, and they're not taking any money out. They're just paying down their mortgage as it existed.
Okay.
But a cash out refinance is one where the borrower is taking some equity out of the loan on top of the mortgage. They're raising their mortgage amount.
Mm-hmm. So explain to me, if you will, where assets come into all of this and whose responsibility it is to prove the assets.
Well, the lender is doing all the proof. That's what they do. Okay. But assets only need to be proven to the extent of the cash the borrower needs to take with them to the closing in order to close the loan. So in the case of a refinance, there's no down payment funds, but what there is closing costs. Remember the 3% that we talked about?
Mm-hmm.
And so the borrower needs to have enough money in the bank to cover the closing costs if they're going to be taking them out of their pocket. Mm-hmm. And we call that an asset that has to be verified.
Now, earlier you said there's two different kinds of refinance, and the one we haven't covered is the cash out refinance. So tell me about that.
Cash out refinance probably accounts for the majority of mortgage loans that have been taken out in America in the past 10 years. And a cash out refinance, on a minimal basis, is where the borrower is just borrowing an extra $3,000 or $4,000 for closing costs. Mm-hmm. It's very limited. He's not really coming home from the closing with a lot of money in his pocket. And mortgage lenders have different rules just for those types of loans because they're not considered by and large a cash out, a true cash out refinance. But mostly what borrowers do is they want to tap into the equity of their home. They're improving it all the time. They're putting in landscaping or roofs. Mm-hmm. And, as their house is going up in value, they want to pull some cash out.
So in those two different scenarios, there really are no assets to have to prove. Is that correct?
Not really.
Okay, so let's say if we go a step further now into a different kind of loan, and that being to purchase a home.
Yeah.
Then what kind of assets have to be proven?
It would be the down payment funds. That's the main asset. But it all starts with signing that purchase and sale agreement. The different steps of when you buy a home start with signing the sales agreement. Mm-hmm. Now here in Massachusetts, a potential home buyer might write out a check for $5,000 or $10,000 for a home that's only $150,000. Mm-hmm. But in Louisiana, for example, a $150,000 home, the first earnest money deposit may only be $500 or $1,000.
Anna, you just talked about the earnest money deposit.
Right.
Now, how important really is that, and is that considered an asset?
It's a very important asset that has to be verified, and there's some background to that too, Kim. One of the things that lenders want to see is that the borrower, when they're getting their first home or when they're buying a home, they establish a history of savings. And this all begins with starting with that earnest money deposit, mm-hmm. no matter how small it is. According to these rules that were established many, many years ago, the earnest money deposit must come from the borrower's account. And so what the lender needs is an audit trail. Mm-hmm. They need to see the money going in and out of the borrower's account.
Now, as they're following that trail, can that money be borrowed from someone else? Because maybe you're a young couple and you're borrowing that money from mom and dad. As long as it goes through your account, is that acceptable?
That's a great question. I wish every lender could stop and think in the same way you're thinking about how this industry works. A lot of people get money from a close friend or a relative, and we call that a gift. But it has to be a bona fide gift that does not have to be repaid. And so what the borrower needs to do is get a gift letter from this person or these people, and that donor has to say, this is a gift, does not have to be repaid, And I think more recently there were some rules there where the donor has to put what the relationship is that they have with the borrower. And so we don't like to think of them as borrowing money for that earnest money or down payment, but if it's a gift, that's perfectly acceptable.
So Anna, you've talked about the audit trail. So what happens next?
Well, next, the borrower is going to be planning on closing the home. And so I'll just give you an example. The borrower buys a house for $200,000. The earnest money is $5,000. But there's a $200,000 purchase price, there's going to be a mortgage of $180,000. So out of that $20,000, $5,000 has already been paid, and $15,000 is going to be brought to the closing. And so there's a total of $20,000 of down payment altogether, and the lender is referring that to an asset that has to be verified.
Okay, so we have $5,000 earnest money. They come to the table for closing with $15,000. That's $20,000 for their down payment. The lender has to verify that money as an asset then. Is that correct?
But it's not just the $20,000. The lender also needs to verify the closing costs. So if the closing costs are estimated to be $3,000 or $3,500, then the asset verification step is going to go up to $23,500. And then there may be an additional request where the lender will say, we need to make sure you've got the first couple of months mortgage payments in the bank set aside, and they'll refer to that as a reserves.
That's tough, by the way, for a lot of people to have that much money sitting in the bank.
Yes, it is, but it works. It's a system that works. In this case, you buy a house for $200,000, you have a total of $25,000.
So Anna, we keep talking about assets. So if you will, explain to me exactly what is an asset and what's this verification process all about?
Well, Kim, the reason why it's called an asset, it's not always about having money in the checking or savings account. An asset could refer to something that's being liquidated, like stocks. You could borrow against a 401k. You could be selling your boat. You could be selling a car. Or you could be just taking money out of another real estate property that you're selling.
Right.
In the case of someone that's moving up into a larger home. These are all fall under the category of an asset, but the asset has to be liquid. But it doesn't necessarily have to be in the borrower's pocket when they're applying for the mortgage.
I see. Okay, so Anna, let's say though that someone is liquidating something else to make this purchase. So I don't know, maybe it's their favorite car, it's their prize Harley Davidson, and they liquidate that and they have that cash, and then ultimately they get turned down for the loan.
Well, hopefully they'll be watching our video and they'll know not to do that.
That's a mistake, huh?
I know, it's a mistake to do that. I mean, what the lender is going to do is verify the value of that asset. Okay. And then the underwriter working for the bank or the mortgage lender is going to give the borrower a commitment, an approval letter, and it's going to say, this mortgage commitment is subject to the sale of the automobile and the proceeds of that sale deposited into the borrower's account prior to closing. That's the way it's done.
So don't rush out and sell something you love.
Good advice.
Anna, this all seems to come back to the audit trail. So again, explain how that all works.
Well, first of all, the borrower is proving that he has established a savings history, that their financial management is involved here. So in a home purchase, it's going to be proof that they use their own funds for the earnest money. And then for the remaining down payment, they need to have that money in the bank, or they need to show where that money is coming from.
And what happens if you are stepping up to another bigger, better home?
Well, those are typical transactions, and those are great. That shows that the borrower was successful in managing their mortgage payment once before, and there's no reason why they wouldn't be a good candidate for a mortgage again. But what the borrower would be asked to do is show a copy of the pending realty sales agreement. And so if the house hasn't been sold or if it's on the market, they might go to the real estate broker and say, well, I need the copy of the multiple listing. And they'll bring that to the lender. And then as soon as the house has an offer, they would be bringing the pending realty sale. And then again, the underwriter would be listing the condition subject to the borrower's closing on their prior residence, and the proceeds would be brought to the closing on the date of the closing.
So Anna, you've talked about all of these steps. Is that consistent across the country?
I'm so glad you asked that, because real estate customs vary all across the country. And it's really hard for mortgage lenders because we're trying to apply universal standards and practices across all 50 states, but the real estate customs vary. For instance, in one part of the nation, the earnest money deposit is held by the real estate broker. In other parts, it might be held by an escrow company, which is typical in the West.
So Anna, when you talk about these real estate companies and the escrow companies, are the banks actually going to them to help in that verification process?
No, not really. What the lender has to do is to see that the earnest money came from the borrower's account, that it wasn't borrowed, if it was a gift, who the donor was, and they need to see it going through as their own savings account. They want to know who's holding the deposit, but it's more important as to where the money came from the borrower's end. But when you mentioned, is the bank contacting an escrow company or a broker, I'll tell you who the bank will contact, and that is a housing finance agency or a nonprofit might have what's called a home buyer assistance program. And so a popular one is called the Nehemiah Fund. And so what the borrower does is they qualify, depending on their income or depending on the price of the house, they might qualify for a subsidized down payment. And so the lender will have to contact that nonprofit or that housing finance agency to just corroborate the fact that some of the down payment funds are coming from that agency.
All of it very confusing, huh?
Yeah, it's a lot of work.
It is a lot of work.
A lot of paperwork.
Right. So Anna, when we talk about the down payment, we talked about the earnest money being put in, but the full down payment of a home, does the bank care where that money comes from?
Yes, they do, actually, for a couple of reasons. The most important thing is that they want to see that it's the borrower's own money and that they have a history of financial management. But people have windfalls. Sure. People get inheritances. People get big cash bonuses from their employment. Right. People could get a settlement. They could sell something. They could be selling another home. It's okay to have all of these events happen in your life and take that $30, $50, or $100,000 and put it into a house. There isn't a lender out there that's going to say, oh, you won that money in the lottery, so you can't buy a house now.
It seems to me if you've got a big down payment, any lender would be happy to see you. It certainly seems that way. However, there is a more common situation that occurs, and that is that you're selling a home and you're hoping to make a profit off of that home that you're going to put as a down payment across town. What happens if that house doesn't sell?
Yeah, it's been a problem for some parts of the country, and I think that lenders are going to have to use their own jurisdiction and internal underwriting rules to make that decision. But very common is to get a bridge loan. The problem is the borrower has to afford it. And so we talked about that 43% debt ratio under the QM rule. And included in that 43% is going to be the payment for that bridge loan and the other mortgage payment.
Right, right. So again, this comes back to the idea that it takes a lot of money.
Yeah.
So Anna, in the end, why is it so important to verify assets?
Well, I think, Kim, we have to remember that assets cover both the down payment and the closing costs. And so on a refinance transaction, if it's a rate and term refinance, the closing costs have to come out of the borrower's pocket. So the lender needs to prove that that money is available in their pocket before they go to the closing table. Because the lender needs to also prove that this money isn't being borrowed. Because when you borrow money, you're incurring more debt. And that's a really important thing for lenders. But I think what I would like to really emphasize here is that there are many, many programs out there that have little or no down payment. The FHA program, the VA program, where the borrowers are coming up with 0, 1, 2, 2.5, or 3% down payment. And many conventional programs where the borrower is buying a home 5% down or 10% down. So every dollar counts. So it's a $3,000 deposit on a house, a $7,000 total down payment. That $10,000, we're going to verify it, but we're also going to verify $3,000 or $4,000 in closing costs and reserves. And so the lender's focus and obligation here is to make sure that no money is borrowed, so that there's no future debt incurred, and that the borrower has all of that money available to them in current liquid asset accounts.